Start the recording as well. Yeah, so yesterday I got a little delayed. I forgot actually about uploading the video, but I've done it pretty early this morning. Okay, so let's look at what we discussed the other day, yesterday. So here we have, okay, I posted these things for you. I have posted these links for you, okay, for checking out. In case if some of these jobs are abroad, you might get a chance to go abroad as well. Okay, let's look at this stuff. We did yesterday. We did this exercise for market risk. Okay, so we can put a little thing with some nice colors. Maybe red is the only color that stands out. And now we'll have a discussion on credit risk. Okay, so this is a credit risk. So I explained what market risk is, and now we can talk about credit risk. Okay, we're discussing. So what are we discussing? Let me just recap. This is this module 6 in this note, which is talking about this term called risk books. Now, risk book is essentially, if you talk to people in the financial markets business, they may ask you questions like, what do you do? If you tell them that I work in a trading room or something like that, they may ask you a question like, okay, what do you do? Are you in sales? Do you do research, or do you run a risk book? So generally, the traders are referred to sometimes as running a risk book, because basically they're buying all this kind of stuff, buying and selling all kinds of stuff. So they are running risk books, which means that they have balance sheets like the example I gave you yesterday with Aman's purchase of options. Okay, that you have. This is what you call a useful way of thinking about a risk book is to have assets and liabilities. Okay, have assets and liabilities. Let's put the center these guys here. Okay, and right, so you understand what is going on here. This is the balance sheet. Okay, so here you have cash, and this is how it's changing. And so a risk book essentially is a balance sheet where you have assets or liabilities. It could be assets and or liabilities. I think that's what I wrote in the in the definition. If you see, so risk book is balance sheet, assets and or liabilities can change in value as a result of changes in the market prices for assets and liabilities. Okay, or as a result of credit events. Okay, so credit events we already defined. And so we looked at the market risk based, we looked at an example of risk book with market risk. And now we'll look at an example of a risk book with credit risk. So let's say if you have a bank, so if you have a bank here with, I'm just going to experiment a little bit with I'm just going to switch on a fan. You guys tell me if the sound is getting much worse for you, because it's getting pretty warm in Calcutta now. I don't know if I should put on the AC or now using the fan. How is the sound for you guys? Is it still okay? Anybody?
Yes, sir, it is fine.
It's fine? Okay, fine. So then I'll keep pressing out of fear of the fan. I have not, out of fear of the sound, I have not switched on the fan. Okay, so this is where we are now. This is the balance sheet. Okay, so this is your assets and liabilities. Copy them here. All right, so this is what is happening here in this case. We are showing you pure examples of a balance sheet with credit risk and a balance sheet with market risk. Now here looking at credit risk. So you have liabilities and assets, and this is your balance sheet. I imagine there's a line down the middle here, and so you have you start first with a liability side with about $1 million in cash in share capital, and initially you haven't started your banking operations, so you have just $1 million in cash. So we're not usually a bank will have, let's say this is $500,000 in share capital and $500,000 in deposits. Okay, and then the bank is going to lend some amount of money, and this is initially just fully lying in cash, $1 million in cash that is lying with the bank. All right, now what happens is at the second stage, what the bank does is it keeps $500,000 in cash, but it lends cash. This is no longer option now. This is actually, let's say, a loan. Okay, so this is a loan to some corporate, let's say. So let's say loan to say Air India has been privatized. Let's assume that Air India has been privatized, and so there is a loan to Air India. You don't want to lend money to Kingfisher anymore because they're already gone. So you're lending money to Air India. Okay, so you got this loan to Air India. Now what happens? Okay, is this? So in the case of a, let's keep the colors properly. Okay. So this is the second period. The first period you start with just cash. Now here again there is no risk, okay? Although because you know that this particular entity, this whose balance sheet you're looking at, is intended to function as a bank, therefore you are already expecting that they are going to engage in some kind of lending. So in general, you would say this is going to end up being a risk book. But as of now, strictly speaking, it's not a risk book because cash has no fluctuation in value. This is the key part, that in order to understand a risk book, you just have to remember the word balance sheet, where some either asset liabilities or both, assets liabilities or both, are going to fluctuate quite regularly in value because of movements in market prices. So if it's in cash, then there's no risk because cash does not fluctuate in value. All right. So this is stage one. Stage two, now we have a problem. Now this becomes a risk book because half is a loan to $500,000 is a loan to Air India. Okay, so now this becomes a risk book because this represents credit risk. This part will not change in value, but this part can change in value. Okay, so let's say the loans have market values as well. I see some names where I can't mute them, but I guess that's the phone entry or something like that. Whatever. Anyway, that's fine. As long as we don't get any background noise, that's fine. Okay, so here you have this. This is the part of making this a risk book because this is credit risk. You have a loan to Air India, and let's assume that loans are actually actively tradable in India. You can have in the international markets. There is a pretty active market for trading in loans. Okay, so there is a big market for syndicated loans. You have a syndicated loan market where banks are bringing out big loans for their customers, and many other banks subscribe to those loans. And then there is a loan trading facility as well, and there is a loan market association document, etc. So it's a pretty well organized market. So let's say you can trade regularly with these loans, and so you can actually see the market value of this loan by looking at market prices and looking at the market information services like Reuters, Bloomberg, etc. Okay, so you have initially you make the loan to Air India, and let's say you sell this loan to many people, many of your other banks. So let's say Barclays India brings out this loan, and then they sell this loan to maybe some of the other banks like Axis Bank or HDFC or Citi India. They all buy chunks of this loan. So everybody has parts of, a lot of banks have parts of the loan, and this loan is being actively traded in the market. So this would be described as a, let's say, 5-year floating rate LIBOR loan, for a 5-year loan indexed to 3-month LIBOR. The initial tranche is $500,000, repayable in bullet maturity. This is called bullet maturity when the entire principal is paid at the end. Okay? So that's called the bullet repayment of principal. So it's going to be described in these manners and in these terms, and it will be traded actively in the interbank market for the secondary market for loans. So this is being traded. Now remember, one of the benefits of trading something actively is that there is price discovery. And if you remember price discovery, what that means is the price is continuously being set and reset. So you can you can figure out where the loan is trading, what the price is. And the way they trade loans essentially is that it will be talking this loan initially has a value of $500,000 because that's what you gave, okay, and that's what is repayable at the end of the year, the tenor. But this is still going to be traded. Usually, what we say is things like 99 cents on the dollar. Okay, I'm just writing it here because I don't want to clutter up those notes. 99 cents on the Okay, so let's put it this way. Actually, usually what we say is 99 cents on the dollar. But in India, if you're trading something, we wouldn't say dollars. But let's say we say it at 99%, okay, of par value. So this is how you trade bonds or loans or any other debt market instrument. So you refer to the percentage of the par value. So now, initially, when you make the loan, and there's immediately there's no change in market conditions, so this loan will be described as trading at par. Okay, it was given at par, and this is trading at par, trading at 100% of the face value. But because of some fluctuations in the market, what might happen is this may, now I'm going to change it to, I'm going to write this as, now this changes to, let's say, there's some kind of credit event, and not even a credit event actually, there is a sort of a deterioration in Air India's credit quality, okay, because stuff is happening in the, airlines are not doing well, and they're not, generating enough revenue, cash flows are poor. Okay, so all kinds of stuff is happening, which is basically this means that the market is reassessing the possibility of this loan being repaid, and now it's starting to trade this loan as 85 cents on the dollar, which is basically 85% of par value. So now what happens is that you have to now what happens to the next accounting period when it comes up, okay, there may be some earlier pressure also to mark down the value of the loan, because if you remember your accounting classes, the purpose of accounting is to present a true and fair picture of the state of the business, right? You remember your accounting classes, true and fair accounting is what they say, right? True and fair. So the accounting is the accounting, and then you also remember the statement called lower of cost or market. You remember this? Lower of cost or market. Remember all these things? Conservatism principle and all this stuff. Okay. So these kinds of ideas that are relevant in this discussion. So in accounting, we want to present a true and fair accounting of the assets and liabilities of the business. And in conservatism principle, if you remember, it's one of the things that flows from there is when you're marking out assets, it should be the lower of cost of market. Okay. So in this case, what is happening is, if you see now the market value of this loan has gone from 100% of the par value to 85%. So you're on the books, the loan is say at 100% of par value, but the market value is, so that's your cost, but the market value here is now much lower. So your accountant is going to come to you at the next quarterly earnings disclosure period. Your accountant is going to come to you and say that you can't show this on the books at 0.5. You have to show it at 85% of 0.5. Okay, so which means now you have to show it as so you have to show it as 0.43. Okay, that's what we are saying. We have to show it as 0.43. This obviously is a little bit more if you increase the 0.425. Okay, so this is what you have to do now. So this is what happens now. Now in this case, what happens is, this plus this. Sum of all assets, it was 1, yeah, so it is 0.95. Yeah. So this is now your owner's equity goes down, and the value of the loan has also been marked down. Okay, so this is called, basically, this is what we call a loan impairment charge. So the accountant was going to insist that you have to show the value of this loan at the market value, and the corresponding debit will also be a debit to the P&L, okay, which is going to show the loan impairment charge, okay, on this transaction. What happened here? Okay, that's what I had feared. Harsh is saying that there's a lot of noise in background noise. That's what I had feared, because this fan is a little bit on the noisy side. So I have now switched it off. How is it now, Harsh? Is it a little better?
Yes, sir. Now it is a little better.
So that was the problem. So I think now we'll have to in the month of January in Calcutta we are switching on the AC. So we'll have to start switching on the AC now because it is quite warm, very warm actually now in Calcutta. Anyway, so all right. So what was I saying? Yeah. So what is happening now is you have this loan impairment charge that will be taken, and now you have seen the value of the assets has gone down. So this is what we also mean by another aspect of our statement, which is what is a risk book, and this is that aspect of the statement, which is that you have asset. This is a risk book now because your assets can go up and down in value, assets or liabilities, and you have seen one example of this, and we have gone through the discussion of looking at many aspects, bringing to our ideas about accounting. We learned in accounting as well. We are recapping some of those principles. You should always study like that from a multidisciplinary perspective. Okay, so this is another example of a risk book. Now, I have shown you isolated examples of market risk and credit risk, but on a typical large balance sheet of a financial institution or other hedge fund, on a typical large risk book, there could be a mixture of all kinds of risk. So these two types of risks could be mixed up together. Okay. So, but we have shown you the examples in discrete ways to help you to understand what is market risk and what is credit risk. So now you have some idea of what is meant by a risk book. Okay. Now, I'm actually, this is one example of a risk book. Now, see here, we have, so this is the term that the market uses, okay, the risk book, to describe, mainly they use it to describe, active risk books, to describe mainly books with market risk. But if you're also trading a lot of credit-related instruments like a loan market trader, etc., that would also be described as a risk book in the general financial industry terminology. Now, what I have done is I have so this helps you to understand what is a risk book. Now, I've given you this term to help you understand what is a risk book, and therefore I've shown you what is not a risk book. Okay, where balance sheet and assets and liabilities can't change in value, like I showed you here, where here it's technically not a risk book because cash cannot change in value. All right. So, but please don't use this term riskless book when discussing with people. This is only meant to give you the idea of what is a risk book. So yeah, so don't use this because nobody uses this term. Okay, right. So yeah, so I've written all this stuff here. Okay, so yes, Sachin, what is the question?
Sir, I have a different question. Actually, my question is not clear. That's why I'm asking. Just like, for example, sir, in futures, we in India, if we buy futures, if we sell future, means we are doing short selling in
Okay.
futures.
Yeah.
So in India. So sir, in India there is for example, if you are trading in the equity, say that we need to is square off within a day in short selling. But in future, is there a time limit time limit in this
Yeah.
more
So
than a day?
you're asking, yeah. So in terms of squaring off the position, that's what you're asking, right?
Yes, sir. In future short selling.
Yeah. So the first thing I would say that in the case of futures, don't. 1 minute. I'm just trying to pull up the NSE web page. But anyway, uh, so the first thing I would say is that in the case of futures, don't use the words short selling. Okay, so let's put this information since I'm since I'm talking about this. Let's put it into the other day. Shaurya was asking about what is the purpose of this, or let's try to open this one. I'm also opening the NSE web page to have a look at the futures. So the first thing I would say, so Sachin's question is basically that in the case of cash equities, when you trade, you have to settle it within 1 day. But if you are trading futures, what do you have to do? Okay, so this my internet connection is still giving me trouble. Although I've taken a fresh connect. I mean, this is a fresh. I've got 2 GB of data for today, and I'm just using it for the first time. So really pretty bad quality connection. But anyway, so let's write it here. So what Sachin is saying is, when do we have to square futures? So the first thing I would say is, he also used a term called short selling. The first thing I would say is, in the case of futures, okay, let's get the, I'm going to write these things because I don't want to disturb that note, because this question is, strictly speaking, a little bit outside the a little bit outside what we are discussing. But I'll since I've taken up the question, I will today is 13. I will finish it off here. Okay. I'm just going to write this briefly. So I could have taken up this question at the end of the class also, but I will just briefly say this. So now, in the case of short selling, short sale or short selling, yeah, let's write short sale. Cash markets, as in so I'm talking about the term short selling, this particular term, either short sale or short selling. I'm saying that this term should only be used for cash or spot instruments. Okay, so Sachin is talking about the example of trading in spot Indian equities, where you have to settle it within 1 day. Okay, this short sale refers to a situation where you sell something which you do not own. Okay, so this refers to sale as first transaction, selling asset without owning it. It is done by borrowing asset and selling it. Okay. So if you wanted to do a short sale in Maruti Suzuki, what you would do is you don't have the shares. Your first transaction is to sell it. So you're going to borrow from the stock borrowing lending facility, stock lending borrowing. We have a facility now, stock lending borrowing. You would enter into a short sale by borrowing the shares of Maruti Suzuki and selling it, and using the borrowed share to deliver on the short sale. Because as Sachin has told you, you need to deliver within 1 day. Okay, so that's the short sale. So I'm just saying, but do not use this term as Sachin has done in the case of futures. Okay, we don't use this term in the case of futures, because in the case of futures, we really don't need to, and these are financially settled futures, so we don't need to, we don't use this term, because most of the cases there is no delivery. So in futures, we just say I'm going short. In the case of futures trading, okay, just say going short, long. Okay, you don't have to say shorts, or selling, or buying, or selling or buying. In the sense that, what I'm trying to say is that when you're talking about selling futures, even if you're doing the selling as the first transaction, okay, like here, okay, you have not bought anything, but your first transaction in futures is to sell it. Even then, you should actually, here we'll see if there's they have changed the web page a little bit. Yeah, let's see what we have in the NSE. So if we have any futures, these are all, they're all, okay. Now these guys have a very, why are they not showing any futures contracts? Okay, let's look at some futures contracts here. Yeah, so you have currency futures, okay, dollar rupee. Now, if you are if you don't have any position, your first transaction is to sell dollar rupee. you would not say that I'm short selling dollar rupee. You would just say that I'm selling dollar rupee futures. Okay. So in the case of futures contracts, we don't use this terminology, which he has used, which is for short selling. Okay, no problem, because that's how you learn, right? So you ask questions, and then I give you all kinds of long answers, correcting many ideas or teaching you how to talk about the transactions. Okay, so this is it. Now, in the case of, so going back to Sachin's question, what is the how long can you hold it? Whereas in the spot, in the case of spot, you have to settle it within T+1, because that's the rule in India. Okay. Now, yeah, here, look at this. This is expiry. So for Sachin's answer to this question, when do you have to square it? You would go back to the discussion I had earlier, if you remember. We have given you a note called futures and forwards. And we open this note, and let me also put a link to this. Okay. In the meantime, while that is opening, let me put a link to this note also, which is our hedging note. Okay. So let me put a hyperlink to this. Right. So that's our hedging note, and this is our futures note. Now, if you remember, answer to Sachin's question will be obtained here. His question is when do we have to close it out? My PC has become very slow. I think maybe there's too much material on my drive. Okay. You see that there is a, I've given you this logic here about first notice date, last notice date, last trading date. Okay, so in the case of these currency futures, since there is no provision for physical delivery, and there is no provision for physical delivery, so the logic becomes very clear. You just you just need to square it before the last trading date. Okay, so the answer will be where are the, yeah. So we have these three important days: last trading days, last trading date, first position date, and first notice date. Because this currency futures contract does not have physical delivery, the answer would be that you have to square it before the last trading date. And in case you're looking at physical delivery futures, some of the futures may be physical delivery. In that case, as a general principle, this rule will apply. Yes. So Sachin, you understand
Yes.
what will be the way to answer your question? Your question is, when should we close out? Basically, you should be looking at this set of rules. Okay. If you have this, so if you have this general set of rules, apply this general set of rules all the time. And when there is no case of physical delivery, when the particular futures contracts have financial settlement, are financially settled, or cash settled, and there is no provision for physical delivery, then some of these provisions will not apply, and you'll basically go to this rule. Okay, that these two rules: close before the last trading date. Okay. Yes, Sachin, does it satisfy?
Yes, sir. Yes, sir. Yes, sir.
Yeah. Okay. Yeah. So long answer. So I should have ideally done this after the class, but anyway, since I went into it, I just wanted to finish it. So let's go back to what we were discussing, which is the concept of the risk book. Okay. Let's go back to the concept of the risk book. Okay. Yeah. Right. Now, strictly speaking, since I've said here, if you notice this, what I wanted to just qualify this definition a little bit. If you see here, balance sheet where assets, liabilities can change in value as a result of changes in relevant market prices for assets and liabilities, okay, or credit events. Now, strictly speaking, actually, I don't know if you know, even nuclear plants are actually bought and sold, okay? So if you have given you an example of a nuclear plant, so you have this, there's a company called, I think Toshiba has a nuclear plant subsidiary in the US. So they have, so even nuclear plants are actually bought and sold. So even nuclear plants have a price, and their prices can change as your technology becomes obsolete. Nuclear technology has been evolving actually. So for instance, a group led by Bill Gates has I think they're building or they've already built a very next generation nuclear technology plant in China. Okay, so it's a group led by Gates. Now, so this is an example of, so this technology is more advanced than what they have in the US right now. Many of the plants are closing because the technology is quite old. So nuclear plants can also change in value. Yeah, so the name of the company, I think, which has the nuclear plants, the Toshiba company is called Westinghouse Electric, if I'm not mistaken. So the point is, but when I say risk book, so technically, since a nuclear plant can also change in value. So if you look at the Westinghouse, if I have the name right, okay, this nuclear plant company, you look at their balance sheet, technically you could also say that this is a risk book because the nuclear plant, strictly speaking, can also change in value. But normally we don't use the word risk book for that kind of balance sheet. We only apply it for cases where there is a fairly rapid change in assets and liabilities. Okay, so in cases of where the assets and liabilities are such that the market prices, the related market prices, change fairly rapidly on a regular basis, on a fairly regular basis. So that's where we use it. This is a little bit of a qualitative, addition to the definition. Okay, so sort of a coloring of the definition. Okay, so basically, mainly we are concerned with market risk and credit risk in most cases where we talk about risk books. Okay, and marking to market, this you already know. So yeah, so marking to market you already know here. So this is obviously relevant for is only relevant for risk books. Yeah, okay. So what is their problem here? Okay. Yeah. Some of these positions for which you, because of which you call a balance sheet a risk book, they may be off balance sheet also. Okay, like derivative contracts. Okay, some of these may exist off the balance sheet, or some may be actually on the balance sheet itself. So so the idea here only is that some of these might actually exist off balance sheet. Some of these. Okay. So because obviously on the balance sheet is quite evidence. Okay. So now here's a further classification that I have. So Sachin, I'm lowering your hand. Okay. All right. Okay. So all right. So now passive. So what we have, what I've done is I've taken the industry terminology, which is very commonly used, called risk books, referring to all kinds of trading books. Okay. Now I have wanted to bring a certain further nuance into this idea. Okay, which is, and therefore I'm doing that by creating this category of active and passive risk books. And so this will have an impact on this because these two are qualitatively different. Okay, active and passive risk books. Now, if you look at so what we are saying here is, where is the active risk book? Yeah, okay. So I have got active, I've got below. Okay, passive risk book, let's decide. Okay, first here. So generally you will have a passive risk book is associated with a hedger. Okay, so remember that a hedger's objective is to reduce risk, okay, but not to increase it. So a passive risk book we talk about as cases like the example that I was discussing with you, like India's exposure to the oil market. Okay? We ask the question of what is India's exposure to the oil market. So we say that India, in a way, has if you think of India as a kind of a company, okay? So India has a exposure to the. You can think of India's balance sheet. Okay, if you look at the government of India balance sheet, if they have the liability to buy the oil for us. And from the point of view of oil, if you look at just India's balance sheet, on the liability side, you look at the oil purchase liabilities, and you would say that this is an example of a passive risk book because we have, in the sense we did not decide as such to have a position in a particular type of position in oil. Most countries have a position with respect to oil. Either they have to import or they have to export. So we just say that, so we just ended up with an exposure to oil because every economy needs oil to function. Okay, so in the case of India, we would say that because we are an economy, we need oil to function. So therefore, because it's like the nature of India's business is to run the economy, part of the our normal business activities would require the running of the economy, and that requires a supply of oil. And in our case, since we are a net importer, so we have to be we are net, basically we have to import oil, and therefore that gives us a particular position. Okay, now we are talking positions like in long short. So we say that here India's balance sheet, if you look at it from the oil market point of view, this is an example of a passive risk book. Okay, so this India is not a very good example, but I wanted to connect to the discussion we started with that day when we started getting into this particular note, technical on risk management at the corporate treasury. So let's look at some better examples. Okay, so does anybody know the name of the company that is holding Saudi Arabia's oil reserves, to whom Saudi Arabia's oil reserves have been transferred? Does anyone know?
Saudi Amrico.
Saudi Aramco, actually. It is Saudi Aramco. Okay, so they did a recent, I think they did an equity IPO. They definitely did the bond IPO first, and then I think they did an equity IPO as well. So Saudi Aramco, this is I think the highest values company in the world, because these guys have. So this is a Saudi Arabian oil company. This is like our Indian Oil Corporation. Okay, so these guys they hold the Saudi oil reserves. Okay, so this is called Saudi. So you should know the name of this company because it's such a big dominant company. Now Saudi Aramco, if you look at their balance sheet, that would be described as a passive risk book, because this is the company that is in charge of basically exploring and refining all the oil, Saudi Arabian oil, the processing the oil and trading it, selling it to the various customers that they have. India is one of them. And so this is what they do. And so when you look at the Saudi Aramco balance sheet, you will basically treat that as when you treat the Saudi Aramco balance sheet will be treated as a passive risk book, because its main exposure will be to oil. So that balance sheet will be like this. Okay, if we take once again. So in this case, today is 13th. Actually, 13th Jan. Yeah. Okay. So, right. So if you look at this Saudi Aramco balance sheet, let's say put 100 billion or 100 trillion or whatever it is, some huge amount essentially. And this is your owner's equity. And here there'll be some cash, let's say, but we won't put it this way. We will assume that there's no cash. Let's put, let's say 100 to 100 oil. Okay, I'm just taking oil reserves. Okay, some of it you can further split it up into oil, like you typically do for inventories for a manufacturing company. You have finished goods inventory, you have work in process, you have raw material. Okay, so the raw material would be the crude oil, and then you will have some work in process, and then you will have some finished goods products as well. So basically all kinds of oil. So now this directly is automatically a passive risk book at this stage itself, because this oil can change in value. Okay, it does change in value very regularly. So therefore it is already straight away, you look at the Saudi Aramco balance sheet, it is already straight away so this is your owner's equity on the liability side, and this is your asset side, and this is straight away already a passive risk book, a risk book and a passive risk book. Now, why do we call it passive? Because Saudi Aramco did not decide to speculate on the oil price. If you want to speculate on the oil price, it is much better to just trade in oil futures. Okay, you have these. I need to keep it here. I should close this. So I'm just pulling up the crude quotes. But the point is that if you, where are we? Here. Okay. Now, this Saudi Aramco is not seeking to speculate on the oil price. Okay, they're not really seeking to profit from fluctuations in the oil price. They are actually in the business of. They're actually in the business of extracting that oil, refining the oil and selling it to their customers. That's their business. They're not trying to speculate. They're not. It's not like they're buying oil and then because they think that the price is going to go up. They have been given reserves of oil, so they are naturally, what we would say, they are naturally long oil. Okay, so they have the oil, and as a result of the kind of business they're in, they are naturally long oil. This is a passive risk book, and this is a passive risk book because they did not go from a situation like what we have here. Now, here's an example of an active risk book. Okay, so I will also write this term here, which is, just copy this, and then we can write some of this terminology here. Active versus passive risk book. So here I'm calling it an active risk book. The example that we took of Aman's option trading, balance sheet. Now this would be, I think, better described as the bank trading book. So they're not, again, seeking to speculate on the prices of loans, but they're actually trying to lend money and pick up the margin. Okay, so this is better described as a passive risk book. Okay, now this also would be a passive risk book, what we are discussing with Saudi Aramco. This would also be an example of a passive risk book because we are an example of a passive risk book where, yeah, so you have this. This doesn't even come into the picture. Okay, this can change a little bit. This will not be loaned to Air India. This will be, we'll do whatever it is later, but we don't need this at the moment. Okay, all right. So the point is, straight away, the Saudi Aramco balance sheet becomes a passive risk book because this is they are not seeking to remember the nature of the business. So to understand passive risk books, you have to understand this the nature of the company's business. Okay, the risks which are arising. So this is a risk book, which means it is a balance sheet which has assets and liabilities which will change in value, and therefore they represent a source of risk. Okay, so maybe I can further enrich the risk book definition. Okay, and so further enriching the definition, hence the books contain risk because they can lead to losses. All right. So this, I'm just adding up this definition, just enriching the definition a little bit. These books contain risk. That's why we're calling them risk books. Okay. Just trying to justify the name that we give to these types of balance sheets. Active versus passive. So what we say in the case of passive risk books is that they contain risks which are arising inevitably from the nature of the entity's business. Okay. Right? So we call it passive because it's not like here where Aman decided to buy. Remember, he had initially had a book which had no risk because he got a bunch of money from his investors to trade, and initially he was in all cash, so there was no risk. Now he started out, and this also you can make the connection to the definition of speculator. You notice initially most speculators would start out like this. Typical example of a active risk book and a speculator. So active risk books are associated with speculators. This is written in your notes. And passive risk books are associated with hedgers. So speculators typically, you will see, they'll start with zero risk. They will start, all speculators will be starting with this kind of a balance sheet. $1 million owner's equity, $1 million cash. Okay, net worth or owner's equity, no debt, only net worth, and cash is the only asset, all in cash. Then he decides to spend some of that cash to buy a risky asset like options. He could have bought some stocks. He could have taken a position in dollar yen. So all kinds of stuff he could have done. But the point is he is buying a risky asset. Now this asset will keep changing in value quite rapidly. And that is what will bring risk to his book. Okay, that's what is basically bringing risk to his book already. So this is what is happening. So notice the important thing in the two-step movement in the case of the active risk book. They always start with zero risk, and then they decide to add on risk. Okay, because that's how they're going to make money. If you don't take risk, how are you going to make money? Okay, so therefore, what you see in the case of the active risk book is also see the connection to the definition of our speculators. We said speculators are those people who, for them, the first transaction will always increase the total risk. See, right now here, in the case of speculators, they don't really have hedges running most of the time. So they have only the original position, the underlying position. So here right now, there's no underlying position. And the first transaction he does is increasing the risk of his book. Here there was zero risk. He bought some risky asset, which can change in value, and it increases the risk. So it also connects to the, as you're studying active risk books, you should also understand, remember the definition of speculator, the first transaction will increase the total risk. And you'll always see this happening with speculators if you go back to the first step. That usually these are funds, okay, or other trading books. They always receive first a trading allocation, a capital allocation, which you may not have seen that step, but it must have happened. Otherwise, where would they get the money to do all these things? That must have happened, and then they went to a risky asset. Okay, they added a risky asset. So this is what you call an active risk book, a speculator's book. In the case of a passive risk book, we are saying that there was no decision as such. I mean, Saudi Arabia does not decide to be a country with oil reserves. They just happen to be that way. Okay, they discovered the oil. Now, so as a result of that discovery, they have oil. Okay, and so there we say that they are naturally long oil. And so the business of Saudi Aramco is to basically extract value from that oil. Now, they are not in the business of speculating on the oil price. What we say about Saudi Aramco is that they are not in the business of speculating in the oil price, because this would be a pretty stupid way to speculate on the value of the oil price, because it takes a lot of time to drill the oil out of the ground, and then you have to sort of refine it, clean it, then sell it to customers, line up tankers for you to ship them. You have to arrange for tankers. It's a big mess, okay? Major headache. So why go through all that headache? You want to speculate on the oil price? There's a very simple way to do it, and that is you just go to NYMEX crude and hope that your PC is faster than mine, and you just hit the futures market, all right? So you just look at the most active contracts. Here you can see straight away, this is how you trade. Now this is why so this is how all speculation works. If you get any news, if you get any major news, like what was happening a few months ago, if you remember when there was a dispute between the Saudis and the Russians with respect to maintaining oil prices and all that. So that caused the oil price to drop. Regarding there was a dispute about output, and that caused a sharp drop in the oil price. So those who can sense what is happening in all these negotiations, and they have a view on what's going to happen, they are not going to go and buy tankers of oil they're not going to order tankers of oil from Saudi Aramco or cancel some orders or whatever with some cancellation options. They're not going to do that. It's too messy. It takes too much time. The fastest way to hit the oil market for when you want to express a view, and the fastest way to speculate on the oil prices is to go and hit the futures. Okay, that's why these are very, very liquid, because everyone is trading, everyone is playing here. Even the major producers. Okay, that's what you're going to see in your trading project, in your hedging project. That the major producers also, when they want to hedge, they don't hedge by trying to buy through the physical oil market or sell through the physical oil market, they all hedge. Everybody hedges through futures. Okay, sometimes maybe futures options. So we'll tell you the story of Mexico. Mexico is a major player, very major player in the oil OTC oil options market. They do a lot of hedging every year, very sophisticated hedging program. So, but they do it in the OTC markets mainly, and so this is how they operate. So when you want to hit the oil market and you want to speculate on oil prices, futures are very efficient because low margin requirements, no headache. Okay, just maintain a bank account just maintain a brokerage account, and you have a view. You can quickly buy and sell these futures. These are very liquid products. So if Saudi Aramco wanted to speculate on the oil market, they would not do it in this messy way, digging the oil out of the ground, storing it somewhere, refining it, and all that. Too much of a headache. They would do it through the futures market. So they are not in the business of speculating in the oil price. Do you guys remember this term called value chain? Anybody remembers in your strategy discussions? Well, let's see. Does anybody remember the term called value chain? Nobody? Okay. So let me just give. So you should know this term actually. You haven't had your strategy classes with Ratan sir. Have you?
Yes, sir, we had.
So you did not discuss value chain. Okay. Anyway, so let me give you that term. It's a useful term to know. So the value chain is nothing but it's this. Okay, so so I'll explain this here. Okay, most hedgers are looking to make a return from exploiting the efficiencies or so this term is a useful term to know from a strategy perspective. It is actually used in business strategy, okay, or operations. So the value chain is nothing. It's a big fancy term, like most of the terms in business. We have big fancy terms for very simple things. So not to speculate on the output price. Okay, let me explain this term with respect to Saudi Aramco. You understand now what Saudi Aramco's business is. They are the company that has the Saudi Arabian oil assets, oil reserves. So their job is to dig the oil out of the ground, refine it, clean it, arrange for the tankers, make the sales. Selling is a very important part of the operation. Okay, they have to find people because sometimes in the oil market you have situations of massive oversupply, as you saw here, if you remember, in this case, where we had that drop in the oil price all the way down to zero actually. Some of the lead futures, the front month futures contract in that situation, actually, this one, which is now 53, that actually had dropped to zero for one day, okay? And in fact, it was negative for a few minutes. So the front month futures contract was negative for a few minutes because of the concerns about the storage facility, because the storage facilities were all full. There was so much oil that the storage facilities were all full. So that's because of those kinds of peculiarities, the price actually became negative, which is an astounding kind of situation. But that's what happened. So their job is basically to do all this operational logistics and also to sell. It's a very big deal. Selling is a very big deal because you have to find customers for all your product. like any other business. Okay, so so as I was saying, so the Saudi Aramco sales team will be very busy. Like you have this kind of a situation. Okay, if you have this, now you see the on all the data. So when you have, there are many times when you have a glut in the oil market. There was a time in the this period about 10 years running up to here, where there was a very low oil price for many years. So you see this kind of a drop as well. So in these kinds of situations of oversupply in the oil market, the sales teams of these oil companies will be very busy because everybody desperately trying to sell. So they'll be calling up people in Japan, in India, in other oil consuming countries, China, and saying, let me see what they. Okay. All right. So they'll be calling up people. So selling is a very important part of the deal. Okay. They'll be tying up customers here and there, trying to make sure that whatever oil is coming out of the ground and getting refined and getting ready to be shipped, they have to find customers. It's like any other business. Okay. Most of you come from business families. You know what's involved in a business. You have to arrange for the product, and then you have to find customers for the product, and then you basically make the margin between the input cost and the output and the sale price. Okay, so the total output cost and the sale price. So that's where you make your margin. So the point here is that Saudi Aramco is not in the business of speculating on the oil price. If you wanted to do that, the futures markets would be a more efficient way to do it. They are in the business of what we say extracting the efficiencies from the value chain, okay, and monetizing them. Okay, so let's change this language a little bit. And okay, so what is Saudi Aramco's business? They are basically trying to make a return from exploiting the efficiencies in the value chain and monetizing them. What is the value chain in the case of Saudi Aramco? It's going to be all that entire oil market process. Okay, that you have to dig the oil. Okay, you can look at all kinds of ways, all new technologies for digging, from extracting. Just mind the. Yeah. So you extract all the oil out of the ground, store it. All these are operational activities. And the whole thing is the value chain. What we say is basically dig it out of the ground, store it, refine it, then ship it in containers, arrange the shipping tankers, contract with the traders to have the shipping tankers ready, pick up the oil, then ship it across to companies, arrange the financial arrangements, okay, letters of credit, all the documents, all these things, the whole, the nitty-gritty of running the business. So that is what we call the value chain. So all of this is value, and we call it value because as you go through the phase, you're adding value. Okay, initially maybe the oil comes out of the ground. Saudis have a very low cost of production of oil. I think it's something like $15 or something like that. Very low cost of production. Okay, so Saudis are well known for having a very low cost of production of oil. That is basically the what we call exploration and production, E&P. Okay, so in the oil business you use this term called exploration and production. So that cost for Saudi is very low. It's supposed to be around $15 or something like that. Then they get it out of the ground, but there's still a lot of work to be done. So all of these things, what's happening is, why is it called a value chain? Because there's a chain of activities. Okay, dig the oil out of the ground, store it somewhere, then refine it, and then package it in, maybe in barrels, then arrange the ships and ship it out. All these things are stages, and as you go through the stages, you're adding more and more value because you refine the oil, so you will be adding some cost to it. Okay, so this maybe is $15. By the time you get to the past after the refining, maybe the price is now the selling price for this product is maybe $35. Okay, so in this way, this is called the value chain. It's a useful term to know. It just refers to the whole sequence of steps involved in running any kind of business which involves a physical commodity. You can also apply it to the provision of a service. You can also apply it to the provision of a service. There will be a value chain. There could be a value chain even in a service-related context, but mainly we apply it for products. Okay, so this is what is meant by the value chain. So the point is that these hedging companies, the hedgers that we discuss, They are not in the business of speculating on the product price, the final product price. Okay, they want to make it a little bit clearer. Okay, exploiting the efficiencies in the value chain and monetizing them. Okay, and maybe we should put all of this in bold. Okay, this is the goal of most hedgers. That is the goal of their business, to exploit the efficiencies in the value chain and monetize them, and not to speculate on the output price. Okay, because that could be done much easier with futures contracts. So that's what we are saying. So this is a useful term for you to learn, and this is the logic. And so that is why the role of the hedger, and that's why we say that a hedger's objective is to reduce risk. The characteristic of the hedger is the first transaction must reduce the total risk. Okay, where have we written it here? The definition of hedging is explained elsewhere in the note on hedgers and speculators, different types of market players. Okay. Okay, so anyway, you see it elsewhere in the note, where we know that the definition of a very characteristic of a hedger is a guy whose first transaction will reduce the total risk. And the total risk will be the sum of the underlying position and the hedge position. Okay, you will see. So that's why, and that connects to this idea here that hedgers are not looking to speculate on the output price. So they want to use hedging to reduce or eliminate risk. Okay, but not increase it. Okay, so the hedger's objective is to reduce or eliminate risk, but not increase it. Okay, and this is something else you need to learn, which is that the purpose of hedging is not to make a profit. There's an example in your text. In the readings I've given you. One second. In the readings I've given you, and there is an example of, now that's real cool. How did Utsav manage to open this? I thought I just moved it out of the, I thought I moved it out of.
No, sir, it was actually in my tab. It was already open. That is why it got opened. It got disconnected as it refreshed.
Okay, good. Because I moved it out for your class. Okay. So, all right. So what I was saying was hedgers' objective is to bring certainty to future cash flows. Yeah. So what they're looking to do is exploit the efficiencies in the value chain and monetize them, and looking to basically what they do is this. So they're charging you. So let's say they're charging you $55 per barrel at the end. Okay, you're the final customer. You're Japan. Okay, Japan's oil importing company. Japan is a net importer. So they are shipping to the Japanese oil company at $55 a barrel, but their cost of production maybe is just total cost is maybe $35 to bring it to the final shipping stage. So they're making the $20 margin, but they are constantly looking to see what is the meaning of what is the objective of Saudi Aramco's business. They're trying to look at all the different phases of their production. And they're trying to see, okay, here our cost of coming out of the ground is $15. Can we make it a little lower? Can we push this down to $12? Then we'll add another $3 of margin. Here on the shipping tanker, arranging the tanker business, arranging the tanker, traffic. Maybe it's costing us $1.50 or something. Can we cut that down further to maybe 1.25? And most businesses have great deal of skill and experience in doing these kinds of things. Okay, they know how to cut down their cost of production and all slowly chipping away at each of these products. If you remember, you guys remember this term called Kaizen?
Yes, sir.
Yeah. So here it is useful to. Not directly related, so I won't put it here. If you see, Kaizen is a Japanese, I'm just mentioning it here, but it is actually, it can be applied here. Kaizen has a much broader applicability, but basically what it is, Kaizen is small and continuous improvements in the production process, okay? And what does it connect to? This is basically what it connects to. That you're chipping away at your production process and making small cost cuts and efficiencies. And what is the end result of that? Your margins are going up because you're selling at the same price, but your costs are going down. So this is what these guys are all about. So all hedgers, that's why these hedgers are not looking to speculate on the output price. They're looking to do this business. They're all in the business of doing this, okay? And Kaizen comes in here as well, Kaizen thinking, trying to constantly extract efficiencies from the value chain, okay? So now, and so that's why what we say, the hedger's objective is actually to reduce or eliminate risk so that they can lock in the margin, okay? Basically, this is the idea. So you have to understand the whole business scheme. I want you to understand the whole business scheme of a hedger's profile, okay? So most hedgers will have this kind of a profile. There'll be some kind of business they're in. If you're a gold mining company, then this oil business changes, but you're doing this pretty much the same thing like a gold mine. You have a gold mine, you have to manage that, you have to manage the labor, you have to manage all that. So you have to dig the gold out, then you have to clean it, refine the gold a little bit. You have to cut it into gold bars, and then arrange for you have a sales team, okay? Like everything else, like in every business, most important part of the sales team, they'll have to contract, they'll have to tie up customers, and then once you tie up the sales, you make the shipments. Okay, so this is running a gold business. Same thing, every day you're looking at, okay, look at all the aspects of the value chain. Where can I cut my costs and extract some more dollars, cut my costs by a few dollars and increase my margins? I mean, that's what the business they're in. So that's why what they want to do when they're hedging is they want to just lock in. I think we don't need these two charts anymore, but they basically want to use it to bring certainty to the future cash flows and basically to lock in the margin. Okay, let's put it this way. And lock in operating margins. You understand operating margins, right? So basically this is the idea that so if you look at this, you go back to this example. Saudi Arabia says Aramco is selling to the Japanese oil company at $55, and but what is happening? So, but their cost coming out to bring it to the sales stage, the cost of production is a cost of goods sold will be $35. So they got a nice $20 margin if they can sell it at $55. But they are sitting, maybe the sales team is not finding much success. So they're sitting with a lot of finished good inventory on the books, and it's looking pretty risky because what if there's another such fall in the oil price? Then if at this point you were able to sell at 55 to the Japanese oil company, you would have been able, if you did the sale. You didn't contact them, but at that time they would have bought it at 55. But when the price drops to $8, they're not going to buy from you at 55. So nobody will. So therefore, they're going to require some kind of market-related price. So therefore, what the sales team, they're trying to constantly sell, but there's no guarantee, of course, in every business. There's no guarantee that you can sell all the product that's coming out of the ground, right? So a lot of the time you have products sitting on the basically our storage facilities, which is unsold product, finished goods inventory, unsold products. So that's why most businesses have sales and all that, is to clear the inventory. Okay, you have discount, big sale, and all this kind of stuff. So what is that? Basically, the sales team is trying to get rid of the inventory that is piling up. And so now what's happening to where the hedging comes in is this, that you've already taken the oil out of the ground at $35. Now you're ready with your finished good, but you haven't tied up your sales yet. Sales team's not managing to do much work. They're not finding much success. So your inventory is sitting on your books. Now this oil price is not waiting for you, it's moving around. So the role of hedging here is to, strategically hedge in such a way that you are able to lock in your 35 to 55 or $20 margin, okay, if that's what you're targeting in operating margins. That's the goal of hedging. That's why you have an example in your book, okay, So it's very important to understand this because many people in the market also don't understand this. Okay, lock in operating margins. Why do you hedge? This whole project you're doing is about hedging, so it's important to understand. That's why I'm giving you some very general business kind of lectures, but it's important to understand the context in which hedging is happening and make sure that everybody understands the basic concepts. So the whole goal of a hedging program is to reduce or eliminate risk, bring certainty to cash flows. Okay, this is another important term to understand. This is really the objective of hedging. You know, not to make a profit. You understand what is meant by certainty to cash flows? Once I'm able to hedge, you'll understand the hedging. Once you understand the hedging process, you'll understand it better. But if I'm able to hedge, then I'm able to lock in my margins. If I hedge in such a way that I can lock in a $20 margin, then what's happening is I'm bringing certainty to cash flows because now I know my margin is guaranteed to be $20. If you read the sections in the textbook, which I've given you, you will understand this. There are some examples, okay? With respect to oil itself, oil futures, there are some examples where no matter what happens to the oil price, you end up with the same result. Okay, so you read those examples and you'll figure it out. We'll deal with them later. Right now, I'm just dealing with the theoretical discussion. But this is the main idea. So what are you learning? Hedgers are basically mostly running businesses, non-financial businesses. And their goal, the useful way to think about a hedger's business is their goal is to exploit the efficiencies in the value chain. Okay? They are not looking to speculate on the output price. They want to exploit the efficiencies in the value chain, do each of the steps in the production process better and better. Now, that's why they are able to control, they have some control over their operating margin, especially on the cost side, okay, not on the revenue side, but on the cost side. And the hedging comes in really on the revenue side, where if they're looking for opportunities, if they get a chance, now the prices have come up here. Now, those guys who lost money when the price went down here, those guys are all running scared. Now, when the price is here, they're all scared like, oh, what happens if this thing goes down again? What happens if this thing goes down again and falls back to below 20 and all that? We are going to lose a lot of money. So we better lock in some hedges at this price. Okay, so you'll see the process later. But this is what these guys are thinking, the hedging teams. The sales teams are desperately trying to find customers, and in the meantime, the hedging teams is looking at the finished goods inventory and whatever is coming down the pipe, and trying desperately to find good prices at which they can hedge. Okay, so that they can lock in their operating margins. So this is the basic idea. This is the whole game of hedging. And running a business and locking in your operating margin. So that's why you'll see there is an example in your book about a treasurer. So I think the discussion in the book, you should be exposed to that idea, but I don't think they understand really, the author, they don't really understand what hedging is about. Actually, they have given various examples, which you should be familiar with them. But they have not brought out this basic idea that the fundamental goal of hedging is not to make a profit. There's a story there of a treasurer who did a hedge, but then they had to pay money on the hedge, although the underlying prices were much cheaper. Okay, so it's like basically what happened in that story is like, imagine that India does a hedge in which they agree to buy oil at, say, average of $40 for the next 3 years. Okay, so that's not a bad deal actually, because it's a pretty low price if you look at the long-term context. So India has locked into buying, say, 100 million barrels of oil at $40. The finance minister does the deal, let's say. Okay. Now what happens is, as it happens, after 3 years, you look back and you see that now obviously you will do this deal before the 3-year period starts, right? It's for the future uncertainty. She wants to lock in the future, remove the future uncertainty. She wants to lock in her net purchase price for the next 3 years. So she does a deal where she agrees to buy a hedge for $100 million for $40 a barrel for India. Okay. Now, as it happens after the next 3 years, we see that for that 3-year period, actually the price drops and the average price for the 3 years ends up being maybe $18. So now what's happening is after the 3-year period, the finance minister is going to parliament and everybody's telling her, you're such a fool. You should have not done any hedging because look at the price, it was only $18. You should have just bought every day in the market and then you would have got an average price of $18. And you're such a fool that you made us pay $40. The problem with that argument is that first, you don't really know when you do the hedge what the average price in the future will be. Okay, so it just happens to be $15, $18 maybe, but it could have also ended up being $95. Who knows? So the objective of hedging is really, that's why this is not brought out in the book, unfortunately. The hedging objective is not to make a profit. So you don't look at whether the hedge is profitable or not. And you always look at the total P&L, hedge P&L plus underlying position P&L. Okay. So basically what's happening is that this is what has to be understood. The objective of hedging is to bring certainty to cash flow. This unfortunately is not brought out in many leading textbooks also. That's why students and people get confused. You are not hedging to make a profit on the hedge. Okay, it's not like you're supposed to make a profit on. You may make a loss on the hedge. You may make a loss on. See here, what is happening is when the average price is $18, we will still end up paying $40 net because we will do our oil prices in the cash market. We'll buy our oil in the cash market for $14. Okay, but because we have locked into hedges which is at forward contracts or futures contracts at $40, so therefore we will have to pay a loss on the hedges from 40 to 18. So this difference we have to pay to the guy who sold us the hedge. Okay, because if it had gone to $100, we would have still bought at $40 and the other guy would be in trouble. In this case, it has fallen, so we will be paying the other guy, so net cost will go up to 40. But we are still doing our purchases at $18. We will see how this operates a little bit better. But right now, the point to understand is please remember this because, as I said, most people don't seem to understand this. The objective of hedging is always to bring certainty to future cash flows and lock in operating margins. That's why we hedge. Okay. And so here, so you have passive risk book. So I've defined two new terms, active and passive risk books. Okay, a passive risk book is more complicated to understand. And I think now you have some understanding of what passive risk books are. Okay, and so we have an understanding also of what is the hedger's objective. Okay, that is to reduce or eliminate risk and bring certainty to cash flows and lock in operating margins. So you'll also learn some new things, new terms like a value chain. And so, because one of the things that MBAs do a lot is they throw some jargon around, okay? So since you're going to be an MBA, but jargon is not necessarily bad because it means you have short words to describe, lots of complicated sentences together. So, so value chain is one of those pieces of jargon which you can learn and throw it around in discussions. So people will think that you're very smart. So it's a useful thing to learn. Okay, so but it has a real meaning. It has there's a real concept involved in this, and so we make sure that you understand it. Okay, now as we said, now this is what is a passive risk book. Okay, and this is what we will be looking at. And then you have the hedger's objective, you can see is to basically reduce or eliminate risk. You can contrast that with the speculator whose objective is to increase risk with a view to making a profit. You saw this, what you were doing in your earlier two projects. You started with a certain amount of cash allocation. There was no risk to start with, but because you know you had to make a profit, you started to take some risk. You bought some options or you bought some spot stocks. Okay, so that's how you would trade an active risk book. In the case of so the way we put it is that in this case, the underlying position did not exist. Okay, you put on the position first. First, you had a zero risk book, and then you put on a position. Okay, and here there's only an underlying position. Generally, there is no hedge position, but there are some examples, some exceptions which I've written about in the note. Okay, which is. But in the case of the passive risk book, what you have to note is that there is already an underlying position. So this is like a little bit one step advanced relative to an active risk book. In an active risk book, you start with zero risk and then you create some risk for yourself by buying, selling something. Whereas in the passive risk book, because you're already in the business, you already start out with the underlying position. Okay. And since you really don't want to be exposed to the fluctuations in the oil price, if you're a refining company, exploration and refining company for, in the case of Aramco, they have. So in this case, you start with an underlying position in oil, and then you try to hedge it so that you can remove your exposure to the to the output price and reduce the risk on your book. Okay, this is what you're trying to do. And so this is the contrast between the hedger and a speculator. Okay, so so here I'm just giving so generally we say that a active risk book is associated with a speculator, a passive risk book is associated with a hedger. But if you remember the example that I gave you, the hedging example in the case of equities, okay, I'll just mention here, okay, recall, okay, VIX and S&P 500 correlation discussion in the options note. You notice that I always hedge myself by saying that generally speculators don't hedge. Okay, but there are some cases where they hedge. If you go back to your options note and read the part where I've talked about VIX and S&P 500 correlation, okay, the discussion on that, I've talked about a situation where they might hedge. Okay, and so that's an example of a speculator hedging because he doesn't want to sell his underlying position. But generally, they don't hedge; they directly buy and sell and increase or reduce their underlying position. Okay, so these are some terminology. Okay, so if for some reason you create two positions which offset each other, we say for fully hedged. But if you sell off the original position, you do not say that you have hedged. You say that you have closed out or squared the position. Okay, so these are some terminology related guidance. Like I was telling Sachin here that you should not, in the case of futures, you should not use the word short selling. You just say selling. Short selling is for markets which are fully funded instrument positions like spot trading in equities and bonds mostly. Right. Okay. So this is again the definition that initial transaction in financial markets for a speculator is never a risk-reducing transaction. It's always a risk-creating transaction, position-creating transaction like this one here. This is the active risk. So the first, you start from here. The first transaction is always going to increase your risk. That's what it is. Okay. So passive risk books and active risk books. Okay. We can look at some. So I've given you this example here. Okay. Underlying position, underlying. So we'll move on next to underlying position, underlying exposure. Okay. And yeah. So I've written something here. Active risk books, let me just cover. I briefly discussed without referring to this part of the note. Okay, so this is the definition. You can read it. Okay, now you know what active risk books are. Basically, this investment funds. Okay, any kind of trading book you might run. Okay, like Whipple is trading. So Whipple's trading balance sheet is an example of an active risk book because there's no need for him to trade. He could have taken that money and just put it in a bank fixed deposit, but he's choosing to take some risk in it using that money. So this is an example of an active risk. Okay, so we'll stop here. We'll continue tomorrow. I'll just we're going a little slowly. I think I'll have to pick up the pace. Anyway, so the class is dismissed, and those who have questions can a conceptual question you can ask it. Otherwise, the rest of the class you can leave. Yeah. Anybody has a conceptual question? Nothing. Sachin has raised his hand. Okay, tell me. What is your question?
Sir, for example, in hedging,
Yeah.
uh, sir, there is also short hedging.
Yeah.
For example, we need
terms-
to
these
we
terms,
need to
yeah. So short hedging. Let's look at short hedge and long hedge. These terms are used in your book. Okay. Uh, short hedge, long hedge. Okay. These terms have been used in your textbooks. These are not very good terms actually, but it's not wrong. It's just not the best possible way to talk about it. Short hedge and long hedge. Basically, let me just write it here. Okay. So what I'm saying is long hedge and short hedge basically is referring to situations where refers to cases where hedge position. Okay. So HP is hedge position. Hedge position.
protect the hedge position.
Sorry.
Protect the hedge position to mitigate the risk.
Yeah, but I'm just referring to the hedge position is the one that is helping to reduce the risk. The hedge position, we will discuss this going forward. You can read the note also. Try to read the note ahead. It'll explain all these concepts. If you can, read it ahead, but I'll explain it briefly to you. Basically, what it is this, that, where was I writing it? Oh, I was writing it here in the session notes, okay? Just next to it. I didn't want to clutter up that note. Long hedge and short hedge, these terms are used in the book. And these refer to cases where the hedge position is long, short. Okay. So you'll see if you read the note ahead a little bit, you will understand it. And when I get there in the note, I'll explain it. So you have a hedge position, and also read the textbook, please. The sections in the textbook that I've given you, they have talked about this long hedge and short hedge. I said not the happiest of terms to use, but it's not wrong. Okay, it's referring to cases where the hedge position is long or short, and there is also an underlying position, which is basically what we are going to discuss next. The next segment is this: that this is where we should start off from tomorrow. Actually, that day after tomorrow, that most investment funds here. That the main thing is that, this is the premise. You can read this, and we'll start from here. So we'll get into this underlying position and underlying exposure, and then hedge position. Okay. So if you go back to the example we discussed today, if you have the Saudi Aramco book, let's say they have 100 million barrels of oil sitting in finished goods inventory. Now that's the underlying position. Okay, that is long oil. And so what they will do in this, they will put on a short hedge. They will put on a hedge to, offset this risk. So since the underlying position is long, the offset position will be short. Okay, so they will put on a hedge that will be called a short hedge if you go and use the definition, the terminology of the Hal Basu. But I'm not a big fan of this kind of terminology. I don't think this is the best possible terminology, but this is what it means. Okay, and strictly speaking, it's not wrong. Short hedge means that the hedge position is short. So in this case, if you sell futures worth $100 million, okay, you have a short position, a short hedge position of $100 million, and you have, the market value of 100 million barrels, because we're talking about 100 million barrels. Okay, so you have 100 million barrels of oil, and then you put on a hedge position for 100 million barrels of oil. Okay, which is basically 100,000 contracts, because each contract is 1,000 barrels. So 100,000 contracts. And you will end it up, so long position, underlying position is long, and hedge position, which should be opposite, is short. That's a short hedge. Yeah. Does that answer your question, Sachin?
Yes, sir. Yes, a little bit.
Yeah. So we'll read. I think a lot of things will become clear if you can read ahead in the notes. The notes are very comprehensive. The note I prepared here, it's quite comprehensive. It will explain everything, and then I'll also explain in class. And I think from the next class, we'll start looking at the actual case balance sheet. Okay. So, yeah. Any other question?
Yes, sir. Yes.
Okay. You have a question?
Okay, sir. No, sir.
Go ahead.
No question, sir. Not clear.
Oh, no question? Okay. Anybody else? Any other question? My internet connection is unstable. I'm seeing that message several times a day. Okay. Any other question? No other questions? So should I stop the recording? Okay. I'm stopping the recording then. No other question?